Okay, let us consolidate. Let us consolidate. So sales revenue, but remember our amount is in dollars. Our amounts are in dollars, so we have put revenue here. Our revenue. So you just pick. You pick the revenue here. 10,700. Why it is 10,700. 10,700. Then cost of sales. Cost of sales. You also pick it from here. 9,630. 9,630. This one gives us gross profit. Our consolidated gross profit is 10,70. That is 10,70. Then less income tax. Less income tax. It is 500. Now the result here it is 570. So that is 570. That is profit after tax. Now it is from here where we are supposed to say profit attributable to this profit, this consolidated profit. It is attributable to NCI. Now the profit related or attributable to NCI, it is, remember here, it is our NCI profit was 120. So what is attributable to NCI is the percentage that goes to the parent, to the NCI. But remember we said it was acquired 100%. So what is attributable to NCI is 0. So this one is 0%. So we can actually show 0% of 120. Of 120. So 0% of 120 is obviously 0. Then now to the parent, attributed to the parent, it is the difference of course between 570 and 0, and that is 570. So 570 is what is attributable to the parent. Yeah, can just stop there. So that is how we have attributed these consolidated profits. So that is our P and group consolidated statement of profit or loss and other comprehensive income. Okay. So that is how we consolidate the income statement. Let's proceed. What about if we have unrealized profits? Let's see how we can deal with unrealized profit. The effect of intra-group trading must be eliminated from the consolidated statement of profit or loss and other comprehensive income. So we are saying if there is any unrealized profit, if there is any trading that is between the parent and the subsidiary and which brings about unrealized profit, then the unrealized profit should be subtracted from gross profit. But what about the sales themselves? Let's first see this. When parent sells to associate, parent has sold to associate. Debt to retain earnings of the parent with the parent's share. Credit group stock uh, with what you calculated. That is when the parent sells to the associate. What about when the associate sells to a parent? Debt retain earnings of the parent with the parent share, then credit investment in associate. And I want us to do some adjustment here because we are dealing with consolidation, and consolidation we said we are consolidating parent and the subsidiary. So let us only look at the subsidiary, not the associate. When parent sells to subsidiary, I will explain that later. Subsidiary, because the associate cannot be consolidated. When the parent sells the subsidiary, debt retain earnings of the parent with the parent's share, then credit group stock. Then when the subsidiary sells to when the subsidiary sells to a parent, debt retain earnings of the parent with the parent's share, then debit, remember we said, then debit NCI, yeah, NCI with the NCI share, yeah, then credit group stock, credit group stock. We are aware of those entries. Those are the entries uh, that we must take. Now, such trading will be included in the sales revenue of one group company and the purchases of another. Now this one from here up to here, we are accounting for the profit. If there is a profit, unrealized profit, how do we handle it? That is, if the parent sells the subsidiary, this is what you do. But if the subsidiary sells the parent, this is what we do. We already know this because we did it some time back. Now the question is, what about the sales? Yeah. Now, because you have the parent is selling to the subsidiary, or the subsidiary is selling to the parent, it means it means it means one is receiving revenue, then another one is incurring a cost. For example, uh, just a minute, just a minute, just a minute, just a minute. Yeah, so we are saying you have the parent selling to the subsidiary, for example. Now, in the parent's revenue, it will include the sales they've made from the subsidiary. Now, in the when it comes to the subsidiary, in their financial statements, they are going to include among purchases. I beg your pardon. I beg your pardon. I beg your pardon. We have the parent selling to the subsidiary. So we are saying in the parent's financial statements, especially the income statement, it is going to include in its sales the sales made from the subsidiary. What about the subsidiary? The subsidiary is also going to include in its income statement, especially in the cost of sales, the purchases they've made from the parent, because they are buying from the parent. So they have included in their cost of sales or in their purchases what they've purchased from the subsidiary. Now, from a group perspective, we say those must be cancelled out because we don't expect the parent to include the results, yeah, of the subsidiary, especially when those goods have not actually gone outside the group. When those goods have not gone outside the group, then we must cancel them out. So what happens? Let's see how we deal with this. Now, in the consolidated sales revenue, we shall say P is revenue plus S is revenue, but we minus intra-group sales. And in the consolidated cost of sales, we shall say P's plus S is cost of sales minus intra-group sales. So that is how we are going to deal with the unrealized profit. For example, let's go to this small example we did. Assuming there were sales from P to S. Now we would come here and we minus those sales. So it was like this. Would minus the sales. Then if we had okay, for the cost of sales, of course, if 55 is sales, then at cost we have to put this one at cost. Then the cost of this, we'll put it here. If it is 50, put it here as 50. So that this 50 will adjust these. Yeah. So we are going to look at how that one is handled. So that is how we deal with unrealized profit. That is how we deal with unrealized what? Profit. Then from there, we're supposed to look at an example. Just 1 minute, we come back, we do the example.